Hi everyone, it's Jack back with another video, and today I'm going to be talking about Stanley Black and Decker, a dividend king that's really down in its luck recently, has a lot of profitability issues in the last year or so, high inventory levels, and a general weakness across the whole industrial sector in a recession environment. People are not so interested in buying tools when inflation is at 10% in many countries. Currently at $89, that's off its 52-week low of 71, but it's still down a hefty 54% for the year. 52-week high of 195. It's seen over 200 in only a year or so ago. This is the worst year it's had in recent memory, probably since 2008-2009. It's been a fantastic performer over the long term. I want to analyse this company because it's still paying a really nice dividend yield, and it's still a dividend king with about over 50 years of consistently growing its dividend, and there's a lot to be had here. The business as it is today was formed from a merger of Stanley Works and Black and Decker Company, 146 years of consecutive dividend payments, 54 years of increasing those payments, making it a dividend king. In the last 21 years, or since January 2000, even despite dropping 50% or more, this year it had 967% shareholder return, 1 billion average 3-year cash generation, which is significantly depressed recently, and a 9% 3-year adjusted earnings per share compound annual growth rate, and that is again despite what is happening recently. 3.6% yield on a forward basis, only 4.6% short interest, which is relatively low, hinting that perhaps the wider Wall Street, despite this being a very well-known stock, thinks that there's still meat on the bone here and there's still a comeback to be had, which I very much think, as they're already turning it around. And just $13.15 billion market cap, 4P ratio of 20, which again I think is a little depressed. Analyst expectations are way down on many companies, way off in my opinion. I think there's definitely some potential for this company. Stanley Black and Decker, as I'm going to talk about more in a minute, is clearly an embattled company, and while they're in the midst of a comeback plan, and they're enacting this plan fairly well in my opinion, there is a comeback to be made, and it's definitely an embattled company, and the dividend could certainly come under threat. That payout ratio of 46.8% is certainly going to rise as free cash flows come dramatically under fire recently. However, what really shines through when you listen to the earnings calls and when you look on the website is they are very proud of their truly excellent dividend record, and you can see this by what they've displayed on the website below. Has an impressive and truly unique dividend record over the long haul, 146 years of consecutive dividends, 507 quarters of quality dividends. That's a record of any industrial company listed on the New York Stock Exchange. Increased the dividend each of the past 55 years. That's every year since 1968. These are all exceptional metrics which they're very, very proud of. Not many companies can call themselves a dividend king. Stanley Black and Decker seems like it wants to keep this going, and it's really essential for this company to keep this going from a shareholder point of view. I think it would be just so negative for the company to lose its dividend and lose its status as a dividend king, and I don't think there'll be much coming back from it in the short term. The most recent numbers we have for this business, which are Q3 2022, showed a couple of bright spots. In tools and outdoor, revenue was up 10%. This is one of the two segments, the other being industrial, which revenue is up 5%. Now, while these aren't overly impressive in the software world, in the dividend king world, and in the industrials world, this is quite good, particularly in a challenging environment. Operating margin, however, did suffer quite a bit, 15.5% for tools and outdoor in 2021, and in Q3 2022 it was just 6.8%. Obviously, higher supply chain costs, production curtailment, low volume, and inflation all worked against this company to give a really quite poor operating margin. Industrial, on the other hand, managed to pass on a lot of its pricing further down the chain, and they recorded an operating margin of 11.1%, which is a very good number and a very good rise over the previous year. But with it being significantly smaller than the tools and outdoor segment, it just isn't going to move the chains quite as it should, and thus overall this company's operating margin has been hit quite significantly. Inventory was a massive problem for this business. They had to do production curtailments to reduce the inventory because they just could not shift it, and they're going to be continuing these inventory reductions into the fourth quarter to support overall reduction in working capital. But this has just really negatively affected the free cash flow of this business. You can see in Q1 2021 we're already starting to see inventory problems, negative free cash flow of $125 million. That's exacerbated dramatically this year with negative $540 million, and this is where dividends start to come under pressure. Year to date, that's minus $2.5 billion in cash flow. This company has the balance sheet to support this, but how long is this going to keep up? The business is definitely trying to right size this problem by reducing its inventory, doing production curtailment, and generally trying to right size this ship, because you cannot keep up a dividend if you're in negative free cash flow, that is for sure. Management provided a really strong update. That is basically that this year is going to be a weak year. They're going to continue to prioritise inventory reduction to optimise the gross margins and then produce strong free cash flow in 2023. That's what this business needs, is to get back to free cash flow positivity. They pivoted to positive free cash flow in September. They continue to prioritise inventory reduction because that is what the business needs for the business to thrive over the next 10, 20, 30 years. That is very much in the mould of the Dividend King. So they can continue to reduce inventory. The planned destocking is obviously negatively impacting their gross margins, which in Q3 22 are in the mid 20%. They predict this is going to get worse, not better, in Q4 and Q1 next year, with the low 20% gross margins, but after that it will continue, and their long-term target is 30-35% gross margins, which obviously is going to be a significant boon for the dividend and also the business. That can only increase earnings per share having a higher gross margin and higher operating margin, and that is going to increase the value of this stock and hopefully get it back to that 200 or above range. Management laid out a plan which just about any shareholder or prospective shareholder would love to see from a business like this. 3 core tenets: reducing complexity, which is essentially cost savings by optimising corporate structure, focusing their operating model and transforming the supply chains. They see $2 billion in 3-year cost savings. This is really significant, of course, and it's going to dramatically transform this business's balance sheet over the long term. And this is only a $13 billion market cap company. $2 billion cost savings is a significant chunk of that market cap, so they can get back in cash on the balance sheet every year. Investing in core growth, $300 to $500 million of capex on innovation, electrification, increasing the market leadership and producing a more responsive, more focused supply chain, and of course enhancing shareholder return, which anyone investing in Dividend Kings and companies of the like wants to see. They see their organic revenue growth to 2-3x of the market right now, 35% gross margin by 2025. As I mentioned, that they're targeting 30% plus gross margin in the near term after perhaps going to be what is going to be a weak year coming forward. 100% plus free cash flow conversion, powerful innovation and improving their customer fill rate. All of these seem like absolutely fantastic propositions, and any shareholder will be excited to see them. Can they pull them all off? It's definitely possible. Management have been probably resting on the laurels, it's fair to say, particularly in 2020 and 2021, where the company has suffered dramatically and the free cash flows fell. There's been a lot of external factors that helped this, but their inventory levels were grossly too high. And they have moved quickly to right size this, and have pretty much done it, even though there's going to be some inventory changes going forward. I think they've done a pretty good job of right sizing this ship. I don't think the dividend is going to come under too much pressure going forward. I definitely don't think the worst is over for this business. I think it could retrace its 52-week lows of $70 or so if in the next 2 quarters its gross margin is impacted as management predict. However, I believe management's plan on streamlining this business. I believe they can continue to provide outsized shareholder returns, and I believe they can continue to improve on their market leadership. At just $13 billion market cap, I think this company has a bit more to fall, but I think it could be a real bargain if it gets towards that $70 again, if you're willing to hold for 3 to 5 years. And that's kind of what I'm willing to do. So I'm going to wait, see how it does in the next 2 quarters, try and pick it up for around $70, maybe a bit more if I'm feeling it, and particularly see what management's updates are on the inventory and the gross margin updates. But overall, I think it's a fantastic business. I don't think the dividend is going to come under too much pressure as long as they can right side the ship within 2 or 3 quarters. I think this is a fantastic business that I will own for a very long time. Of course, this is just my opinion. You should let me know what you think in the comments below. Don't just listen to what I'm saying. Do your own research and due diligence, because I'm not a financial advisor. Let me know what you think in the comments below. Like and subscribe and enjoy the video. See you again next time.